Hello, hello everyone. Just be aware that everyone is muted, and so I'm gonna keep everyone muted till we start taking question answers. Also letting you know that my assistant is logged in. Her name is Christine, and she will also help you because I won't be able to monitor the chat. So she may be able to answer some of your questions. So let me just admit, we had quite a number of people register for the event. Some of them might not show up for the live portion, which means they should be able to get their recording of this. So, all right, so let's get going. Thank you so much for taking time on a Saturday to be here. The reason why I created this specific workshop was I see a lot of people in the community who struggle with this. I did struggle with this when I was first starting out, and I didn't understand the difference. Um, I feel even for people who are in real estate for a while, even they struggle with this. So I thought, let's talk about the perspective of the lender. And so I'm going to divide those in different categories. Then I'm going to talk about what is that they're looking for, what kind of properties they're looking for, what is their perspective. All right. So the title of today's workshop is Private Money Lender Psychology. All right. So like I said, everybody is muted. Here is what I'm planning on doing. The workshop itself, we have two parts, right? The first part is the workshop. It's going to be about 20 minutes, 20 minutes, I think. And then 10 minutes I have reserved for question answers. So if you have a question, just raise your hand, and then we'll go from there. By the way, I just want to make sure, can you just give me a thumbs up if you can hear me? Because I might be just talking. Just put a, okay, perfect. So 20 minutes of the workshop, then 10 minutes of question answers. And then the second part is when I'm going to introduce my coaching program about raising private capital. Also 20 minutes and then 10 minutes for question answer. So that way, I don't want to keep you too long. All right. So, having said that, what I'm going to be talking about are following six things. Number one, how to identify different types of lenders, why hard money lenders would not do the slow flip model, why some experienced PML would never do the slow flip model, and why is it hard to convince PML on the slow flip model. And then I'm going to talk about how to have that conversation to identify your prospective PML problems, and then how to connect those PML problems with the slow flip model. All right. So in other words, I'm not just going to talk about the psychology part, but I'm going to also discuss the problems and then how to connect it. In other words, I'm going to give you some solutions and suggestions. All right. Okay. So on remember, everything that I talk about today has to do with residential real estate because of obvious reason. We are talking about slow flips. All right. So don't confuse and assume that why did I not mention some other type of lenders, because they either exclusively focus on commercial real estate or other kind of real estate. So these are the four broad categories that focus on residential real estate investments. Number one, traditional lenders. Number two, hard money lenders. Number three, so these are the terms that you want to be very, very careful about. Private money lenders, and I put it in brackets, sophisticated. All right. And the last category is private money lenders. And instead of using the word unsophisticated, I decided to use the word emerging. So we'll call them private money lender, emerging private money lender. Hopefully that makes sense. All right. So we all know this. We know about the traditional lenders. When we talk about traditional lenders, we're talking about banks, mortgage lenders. These are different categories. Credit unions, portfolio lenders, right? Now, here's the tricky part in this. While you can work directly with lenders, many of these lenders in this category use brokers, right? So let's talk about the brokers first, right? What are the advantages? Obviously, time saving, because brokers can simplify the process for you because they work with a lot of different lenders at the same time, right? and it's cost efficient because they may help you find a borrower who will save you money, right? So reduce fee. But there are some disadvantages, right? The disadvantages are because brokers are not direct lenders, they cannot approve your loan. They cannot make the final decision. So you're really dealing with someone. If they're not understanding your model, they may not even be able to find you the right lender. This their services may not always guarantee better deals compared to direct lender applications. So just be aware of that. Now, so I'm not going to spend a lot of time on traditional lenders because you probably have dealt with them. You already know the problem with uh, working with direct lenders is I've used them, and when you're a real estate investor, remember the biggest limitation is the number. First of all, they look at credit and they look at the portfolio itself, the valuation. And based on that, you are very limited to how many loan, they call them credit lines, you can have. Most direct lenders will not let you borrow more than 10 lines at a time. So which means you're capped at 10 homes, and after that, they will not lend to you. You can go to the other lenders after that, but again, they look at those 10 lines and they may or may not even lend to you. So that's why I'm not spending too much time on traditional lenders. All right, but here we go. Interesting. Hard money lenders. Okay. And I just want to give you a definition so we are very clear what we are talking about. Hard money lenders provide short term asset based loans focusing on property value rather than the borrower's credit worthiness, right? So they're interested in and working with you on a following basis. Number one, they want to see the collateral. So they're looking at LTV ratios. And if you don't know, loan to value is LTV. Their short-term structure, which means they will only do 6 to 12 months, and speed, they will work really fast. They can do it in a week or they can do it in days. So what are the advantages of working with hard money lenders? Well, if you do want to work with them, they of course they will approve you really fast. Funding can be dispersed within days. Their even terms can be flexible. They can change the payment structure, interest rate. They can be very flexible on that. But here's the problem when it comes to slow flip model. A lot of private money lenders, you may or may not know this, are they call themselves private. Sorry, they call themselves hard money lenders. They are identified as hard money lenders. So number one, this is not on the slide, is that a lot of hard money lenders call themselves private money lenders. Let me repeat that. A lot of hard money lenders market and openly list themselves as a private money lender. Now there are two sides of this story. The problem is number one, they could be actual person who has their own funds. So a lot of these lenders may have their own funds, right? So they said, well, I'm a private money lender. The problem is they're doing this professionally. So in my book, that's how I put them in a separate category. So they may call themselves private money lender, but since they're doing this professionally, I put them in the hard money lender category or the bucket. Okay. But here's the big thing you have to understand. Within that, there's also an issue because some of these people are just doing arbitrage, which means they themselves actually do not have a lot of funds. What they do is they just have a lot of connection with other individuals, but these are all other professional individuals doing this professionally. And they borrow from them at a different interest rate and they will lend to you at a different interest rate. So obviously, costs are very high. We're talking about 8 to 18% or more. And the fees could be 1 to 3% on origination fee. And typically, their payment period is short term, 6 to 12 months is what they're looking for. So, how do you, so that's hard money lenders, right? Now, let's talk about private money lenders. Now, these are actual individual private money lenders, but they're not professionals. All right. So let me repeat that. They are, sorry, let me correct that. They are private money lenders, but they are not professionals. So I call them the real private money lenders, right? But I put in a category sophisticated. So these are the people who have been doing this for a while. They're not doing it professionally, but they have a lot of experience. And so uh, this is someone who's experienced but does not lend money professionally. Okay, what makes them different is that they will consider borrower's reliability and the project as a whole rather than just the collateral. Do you see that? That is the difference between a hard money lender who will actually look at the asset itself and the viability of the assets. So this is something that a sophisticated private money lender will do. So what are the advantages? Well, they primarily will use their own funds and they can approve and fund you very quickly. So they have their own money. They can be flexible in their loan terms and structure based on project viability, right? However, there are some disadvantages. Number one, since they are very experienced and they're used to taking high risk, they do charge higher interest rate generally. All right. And they're used to doing, again, short term loans mostly, and they dislike tying up their funds for longer period of time. Now comes our favorite category, a private money lender who's the emerging private money lender. All right. So again, this is not a hard money lender. This is not a sophisticated private money lender. This is a private money lender who's either just starting out, does not have a lot of experience. So I call them emerging private money lender. And Scott talks about these people. Those are our ideal private money lenders. That's what you should be looking for. All right. Now, this is typically an individual who is neither a professional nor a very, very experienced private money lender. They have funds sitting in their accounts, not earning enough money, and they're willing to lend as long as they're satisfied, the operator is reliable, their principal is safe and secured while they have asset backed guaranteed documents like the mortgage and promissory note and all that. Hopefully that makes sense, right? All right. So how do you, what are the advantages? Obviously, we know that they have the money. So fast funding, they'll usually have cash available in their retirement accounts or bank accounts. So that's not a problem. They'll give you excellent terms. They will work with you, right? As long as the terms are reasonable, they will work with you. So those are very big advantages. Here are some disadvantages, right? You have to educate them. Since they are not familiar with, since they don't have a lot of track record, they may or may not be familiar with the slow flip model itself, or in generally, we're talking about real estate. So you do have to educate them. All right. And the other thing, which I feel is a little disadvantage, is while you expect them to do their own due diligence, you do need to provide quite a bit of information about your property. All right. So in other words, you have to do a lot of due diligence, which you should anyway. As a professional investor, you should be doing your due diligence on any property you bring to your private money lender, right? So if you do this right, then you're good. All right. So now the second section. Why hard money lenders would not do slow flip model. And I want to keep talking about this is because I see so many comments on our forum where here's the deal. Hard money lenders work this way. They, number one, portray themselves as private money lenders. So a lot of newbies in our community, even some experienced people, start this communication with them, right? And I can tell you this. Sometimes these hard money lenders may know upfront that you probably may or may not qualify, but they work on a basis of leads. They just want to talk to 100 people, bring them in their system, spend time talking to you, and at the end they will say, oh, by the way, yeah, these are our terms, and this won't work. So that's why it's very, very important very early on to understand. If you find out that they're hard money lenders, then you need to know why would they want to even work with you. All right, so here is my take on it, why hard money lenders are not interested to lend us for a slow flip model. All right, number one, subject property valuation. They want to ensure they will, first of all, they will never lend more than 50 to 80% loan to value, right? So we are looking for 100% financing, right? We want most of our lenders, that's how they work. If they're closing costs and on all that, it depends on how you structure your deal, but ideally ours is 100% finance. So they're not going to finance 100%, number one, right there. And then here's the other thing. They are primarily interested in property value upon operator exiting strategy. All right. So the exit strategy is something very important. They will ask you at the beginning of the discussion, well, what are you planning on doing? Well, for them, an exit strategy of 5 years, well, based on, if you look at it, even after 5 years, we're not really exiting from the project, right? So this is a portfolio we're going to keep. So as far as they're concerned, there is no exit, right? So that's a problem. Uh, so so unlike fix and flip, which has an exit strategy, and it can they can show potential increased valuation. Unfortunately, our slow flip model does not. Right? You may have somebody in your property who may fix a property and sell it, but again, as far as the hard money lender is concerned, that spread is not there. Right? So in addition to that, the cost of the loan. So let me give you an example. And these are just rough numbers for your idea. Let's say they say, okay, fine, we're going to lend you $30,000. Well, based on our idea of even if they lend you the maximum, which is 80%, which means you will have to bring to closing at least 9 grand on a $30,000 loan, plus their fees, which could be between $2,500 to $3,000. In other words, to close a loan with these people, you would need more than $13,000 to close a loan of $30,000. That doesn't even make sense, right? It does make sense to them because they're charging all the fees, all right? So understand that instead of wasting your time, understand who you're talking to very quickly upfront and know that it's simply not viable for the slow flip system. All right. So a few other things. Minimum loan amount. This is the easiest thing for you to first find out whether you're talking to a hard money lender or not. Is that what is their minimum? And a lot of hard money lenders and even some sophisticated private money lenders, their minimum is at least 60,000, 50,000 or higher. I've come across a lot who will not do it under $100,000. So that itself will tell you that okay, these guys are hard money lenders, and that's their minimum. And right there, you can't do a slow flip, right? Because our average is 30, could be a little bit more. And then the other big thing is shorter terms. Most hard money lenders will not lend for more than a year. A year is maximum. Six to 7, 8 months is what they want to learn. So they are looking for velocity of their money. So it is just not viable for you to work with them. So that's what you're wanting to do. All right, next. Now let's talk about why some experienced private money lenders. So I'm now not talking about hard money lenders. I'm talking about sophisticated private money lenders. All right. So why some experienced, sophisticated private money lenders may not do the slow flip model? And I'm using the word may not. All right. So I have some sophisticated private money lenders, so they will, depending on how you approach it. All right. And there's something that I actually talk about in my course as well. So number one, they are used to dealing. I'm talking about sophisticated private money lenders and charging 1 or 4 point loan origination points. So if they've done past deals, fix and flips, and all other type of deals, they have charged points. So they're expecting to earn addition on top of interest payments. So that's their expectation. In our slow flip model, we don't pay loan origination fee, right? Number one. Number two, they are used to doing fix and flip, like I said, because that's a very simple model to understand because there's a very clear exit strategy. And they're used to terms of 3 to 6 to 8 months. And again, you suddenly throw in that 5-year term, it's hard for them, right? So, but here's something, let me tell you. So, okay, let's talk about number three. They're used to charging a lot higher interest rate. It could be between 15 to 30%. And in our slow flip model, if it's over 20%, sometimes it may not be even viable. So that's another big challenge. However, that's why I have that light bulb over there. If you are able to do an incredibly good job in presenting your slow flip model effectively, right? That's the thing. You have to be effective. And then you address their specific problems. You can sign up sophisticated private money lenders. In fact, they'll be your best private money lenders. I talk about that later on in the workshop now today. So I hope that was helpful on that part, right? All right, so let's conclude up to this point. Number one, identify hard money lenders and avoid them. Simple as that. Number two, identify sophisticated private money lenders. While harder to convert, you must do an exceptionally good job to convert this type of lender. All right, you can, it's just a little bit harder, right? So you have to have your messaging correct. You have to really know the model. If you don't understand, or you cannot describe the slow flip model in few sentences to a friend or a family member, it's going to be harder talking to a sophisticated private money lender. Finally, identify and target emerging private money lender as they are your ideal private money lender. And what you just need to know going into that relationship is that it is your job to educate them. Okay, they're not going to self-educate. You have to be the one educating them. All right, now I'm going to talk about the meat of this workshop. All right, so I hope this was understandable up to this point. Now I'm going to talk about that actual conversation. All right, so how to have a conversation to identify your perspective. I'm using the example of emerging private money lender, so which is easy because, like I said, let's start with that because they're the easiest one to convert, right? So before you explain the slow flip model to them, you have to ask them two main questions. These two questions are very important because if you don't ask them, you and your potential private money lender are talking two different languages. All right, so very important. Two questions. Number one, where is your money and how much is it earning? That's question one. Question two, how much do you have available and can you commit to investing your funds for 5 years? Actually, there are four questions, but I put them like that. All right. Now, what is the benefit of asking these questions right up front, right at the beginning? Because if you don't, you won't have answers to critical questions. Okay, so number one, where is your money and how much is it earning? So um, this will answer whether the funds are liquid and immediately available. You obviously want to know that, right? Number two, whether they are earning less than 12%, right? What if they are earning more than that? It's possible, right? So how will you solve that problem if they're earning more, right? So you need to know these questions. And then how much do you have available and can you commit for funds for 5 years? So how much, obviously, it will tell you if they have at least 30 grand and whether their investment horizon matches the slow flip model of 5 years. Does that make sense? Now, how do you do the connection? Well, let's make sure. So you are confirming, you need those four checks, right? Remember, I said two questions, but there were really four questions within those, right? So number one, we need a check whether the funds are liquid and immediately available. Check. Number two, whether they are earning less than 12%. We need a check. Two, how much do they have available to invest? If it's at least 30 grand, you got another check. And whether their investment horizon matches the slow flip model. That's your fourth check. Does that make sense? Now, do not go further until you verify this because otherwise you'll have to come back. So now that we know that, now what we are doing is we are find out why your potential private money lender is exploring other investment options. So now really you're asking them to justify and explain to you their problem to the extent that you can now match the slow flip model for them, right? So find out why your private money lender is exploring other investment options from what they're doing right now, right? Number two, find out the reasons why they need to earn more. Maybe they're retiring soon. Maybe they have a grandchild going into college or whatever it is you need to know, right? Okay, so this will identify their problems. Now you have to connect each of your problem with the slow flip model feature. Okay, that would solve their specific problem. So problem, I could lose my principal. I have money in the stock market and what's going on in the stock market, I could lose my principal. Solution, slow flip model is secured with real estate. Do you see that? You're actually giving a solution to a real problem that they all fear, right? Problem. I'm earning 5 to 6% and I'm not even sure after the fees I'm even earning that. Solution. Your slow flip model will produce passive income of 12%. Does that make sense? So now I think I don't see any hands raised, but I can take any questions. Raise your hand so I can see it, and then I'll have to unmute you. Yes, Michael, go ahead. Unmute yourself, please.
Hey Amir, thanks for doing this. Can you just show those four questions again so that I can take a screenshot if that's okay with you? So, because I might be talking with a PML later on tomorrow.
Absolutely. That's very good news. Um, I think yes. So there are basically four questions. I put two questions in each.
Okay, so can you go back to the other one? I think it's
So this
is
is
it
this is the four questions, but here's the other one.
okay. These are the four questions, right? Essentially.
Yeah, so each question has two parts. Where is your money and how much is it earning? So do you see that there are two
Okay, that's the
questions in one
first
question?
one. Yeah, I
Yeah,
got
and
it.
then the second one says how much do you have and can you commit to invest the funds for 5 years?
Okay, I've got the first one in my buffer. I'm going to paste it, and then I'm going to grab this other screenshot right now. Print screen, grab it. Thank you.
Sure. All right, so tell me about if you don't want to, that's fine. But I want to figure out how did you find private money lender based on what I just explained. Where do you think he or she sits in that spectrum?
Well, he is a business owner, or was a business owner. He just sold his business for $5, $10 million. So,
Okay.
and he was, last time I was talking with him, he's a friend of mine that he had, I mean, he's got 5 million. He sold his business with his brothers. I think his share was 5 million. He's got a very nice house and lives a pretty expensive lifestyle. Honestly, I don't think 5 million is enough for him given his at his age. And so I think he's looking to multiply it with other investments and so forth. And he kind of mentioned that to me. So last time I talked to him. So tomorrow when I see him, I hope to ask him to see, to ask him these questions. I see this is the first question is number one, number two. Can you again show me the other two questions? Thank you. Okay, cool. Yeah, so that's my take with him, and hopefully maybe he could be a great source of many, many flips.
Absolutely. And good luck on that. And just keep me posted. I'd like to know.
Thank you.
All right. You're welcome. Kim, how are you, Kim? Go ahead, unmute yourself. Oh, did we lose you, Kim?
Okay, there.
There you are. Hi, how
Oh,
are you?
hi, how you doing? I'm
Good,
great.
good.
Um, a question. One of the is how much do you have available? How can you ask somebody that? Most people are very, funny about that. So how
So you're saying that question of how much do you have, right?
right? That's very
Okay. All
uncomfortable
right.
question.
Well, let's yeah, yeah, no, that's a very good question. So let's get to that. So at some point you're going to be either meeting with them or talking with them, right? So you're going to build a little rapport. You have They have to know what you're doing, obviously, right? So in other words, before these questions there has to be some kind of introduction, some kind of hey, I'm so and so, this is what I do, right? So that is something you have to build up on enough so that there is enough trust to have this conversation, right? Because otherwise, any stranger from the street can come up and start asking you these questions. That's not what we are trying to do. And obviously, that won't work, right? So you need to work on that, which is either your pitch, either you should have a pitch, right? You should have, this is what I do. I'm a real estate investor. I've been investing in real estate for 5 years, and currently, I'm investing in distressed single family homes in the Midwest. I help my investors, earn whatever it is. That's what you're doing before you're having this conversation. Obviously, if you don't, then they don't know who they're talking to, right? So get comfortable. It's something that comes with a little. After you do a couple of these, then it'll be very natural. But yes, you do need that introduction. Did that answer your question, Kim?
Yeah, I guess like you said, just have to get comfortable with the pitch. Because the people I've been talking to have been people I know, but I haven't been
So let
able
me,
to
yeah,
just
let
come
me
by that.
say another thing for you to help you with that. Here's another thing. I'll use the word anchor. Okay, so let me give you an example. So let's assume, I'm giving an example. Let's say you're a practicing nurse, right? Nurse professional, certified nurse professional, right? And you have colleagues who are also registered nurses, right? And then you're doing real estate on the side, right? In their mind, the anchor in their mind is that you're a nurse practitioner. It's not that you're a real estate investor. So your first job is to remove that anchor. And that's not easy to do, because what if you've known them for years and that anchor has been there for years? Do you see what I'm saying? So that is a little bit more work. That is true, but that's something you will have to overcome. That's your job as a real estate investor, to tell them how serious you are, what you're doing, and why are you making this pivot. Do you see that? So yes, that is a challenge, absolutely, because in their
Yeah.
mind you're doing something else, and now you're saying you're doing this. So you need to really show them that you're serious about what you're doing, and how they can benefit from this opportunity because you're doing this.
Okay. Yeah. Okay.
Okay,
Thank you.
you're welcome. Dennis, go ahead and unmute yourself, please.
Hi, Amir. How you doing? It's Dennis.
Good, how are you?
Great. Hey, yeah, so basically, we were fortunate, me and Gina were fortunate enough to get our first private money lender. We closed on a property Monday, and that was our first one. We were
Congratulations.
excited. And the strategy that we were using is basically um, just talking to family, friends, coworkers, just everybody in our warm market network, and using kind of Scott's strategy of don't ask people for money, and more or less ask them, hey, do you know of anybody? And also another thing was we're not asking for money, we're offering an opportunity for
Mhm.
somebody to earn better returns. So that's kind of the strategy we were using. And like I said, we had a couple married couple friend of ours in our circle. They've known us, we've been friends for a while, so we had an element of trust there. So Gina was actually the one that was talking to her friend Miley, and she got excited and told her husband, and that kind of how that was born, and they ended up coming on board. So um, now, given that, outside of my question is, we're just constantly talking to our family and friends and people about what we do. We're excited about it, and that excitement is contagious. And I figure, hey, if somebody's interested, they're going to say, hey, what about me? But outside of that circle of family, friends, coworkers, do you have any other suggestions that we can reach out to, or how we can expand that beyond our inner circle? Anything like
Yeah,
that?
absolutely, absolutely. And that's actually something I'm going to talk about later, that I teach. That's a part of my coaching program, but I can give you some ideas. So,
Okay.
number one is a concept called the tribe concept. And what it is, Dennis, may I ask, do you have a W-2 job?
Yes.
Okay, and you mind sharing with me like what
Yeah.
path?
Yeah. I've been law enforcement. I'm a deputy sheriff in LA County for,
Okay,
yeah.
perfect. That is perfect. So everybody has different tribes. So let me clarify this so you understand. So
Mhm.
one of your tribe is your buddies at work. That's a
Yes.
tribe, very strong
Yeah.
tribe, right?
Right.
There's another tribe. Let's say you have kids and you have a baseball team, and the families meet after each match and they go out to eat or whatever. That's a
Okay.
tribe, right? And
Yeah.
then you might be a member of your church, you might be a very prominent member, you do a lot of things, and then there are other people who do a lot of things. You meet, you talk, you share ideas.
Yeah.
That's another tribe. You
Okay.
have to figure out, as a family person, as whoever you are, which of these tribes are the strongest with the strong ties. How strong do you feel you are in one of these tribes?
Hmm.
And that is something you can use, same strategy that you use with your families and friends, to
Hmm.
share the excitement about what you're doing for yourself, for your family,
Hmm.
and then ask them same thing. Hey, do you think anybody could benefit from this?
Yeah.
Because it's in that tribe, you have the similar trust.
Okay. Cool.
All right.
Thank
And
you.
just follow, if you watch the rest of my presentation, I actually go into a lot more detail. Okay.
Okay. Yeah, I'll be here. I'll
All
watch.
right. Okay.
Thank you.
Next up is Warren. V. Sorry. Go ahead. Unmute yourself.
Hi.
How are you?
Bee or burn, that's fine.
Okay.
I'm good. I'm good. I'm good. Okay, let me just here we go. All right. Hi. So, my question is, do you have a sort of a just like you have a buy box, right, for the property? Do you have something a similar kind of profile for your PMLs? And the reason I ask this is, we know if we go with a traditional bank, right? Um, we have an agreement in place and it's a 30-year mortgage or whatever, right? The bank's never going to come back to you and say, hey, I have an emergency. Can I have my money back? And I know we have agreements notwithstanding, right? I wouldn't want to take somebody's last $30,000, right,
Yeah.
to put into this, right? Because you don't want them coming back and saying, even though you have an agreement, hey, this emergency came up, you know, whatever, what have you, have my money back, right? So is there something, some sort of guideline um, that we should be
So
thinking of
that's
when we're
that's a good
approaching
question.
people?
That's a good question. So number one, let's address the question about people wanting their money back. So let's face it, if it is an emergency and it's such a big emergency that it's a huge financial burden and it can ruin somebody's life, well, guess what? You're also going to try to help them out. All right. So there's no denying it. No matter what the contract say, I'm talking about something outside the contract, right? Here's what you can do, which is you would do anyway. You would say, look, as you know, as per our contract, you can exit before 5 years, but considering your situation, give me some time. I cannot promise you, but what I'll try to do is find another investor who can step in and take over, and so we can have a payoff. And all then you're doing is, which is actually not very hard. I haven't done it, but what you could do is then go back to your pool of private money lenders and tell them, hey, I have a performing asset, 4 years left on it, same interest rate, whatever. Are you interested? Well, guess what? If it's a performing asset and you can show that the payments have been there, um, it won't be that hard. It might take you a month or so to do it. That's why you don't want to commit to your existing private money lender by saying, yeah, 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 I'll do it. I'll take care of it within 7 days. Don't say that, right? So do it as a favor to them, and that's exactly what you're doing. So hopefully that answers that question. Now, that buy box thing, that's a little hard because everybody's different. Everybody has different criteria. That's why I wanted to today's presentation, I wanted to do it by categories. So just put people in the categories, figure out whether they are a hard money lender, so avoid them. Just don't waste your time. Find out whether they are sophisticated private money lender or whether they are emerging private money lender. And so when you're pitching to a sophisticated private money lender, you better have your pitch deck down. You better have your elevator pitch down, and you better be prepared. If you're not prepared, I would not do that pitch because they're going to tear you apart. I've had that done to me, so I know. Okay, not it's not that they're going to ask you questions that you might not know. That's not just the issue. It's just that they are some of them are so aggressive that they will beat you down, right? So you want to be unless you're not ready, I wouldn't do that yet. But go to the fourth bucket, which is your emerging private money lender. And like I said, the way you find out is you talk to them, you ask them questions, and they'll share these kind of things with you, even if you don't get to those four questions about how much money you have. But you ask them, how many deals have you done? Have you lent money before? Have you, if you have, what happened? And based on that, you will figure out, is this somebody who is sophisticated or not? You'll be able to do it. Trust me. It's not that hard. You'll be able to do it. Cool. Hey, Zach,
Thank you.
go ahead, unmute yourself. How are you?
Hey, Amaya, thank you so much for doing this workshop. Like, this is kind of like a teaser. It's awesome. So I have one question, right? I kind of like started talking to my potential prospective private money lenders. And then I want to ask you about two objections that I typically get, right?
Mm-hmm.
So the first one is about, they get scared when I say, I didn't say the word distressed properties, but I say, cheap properties, right? When they know, like when I tell them, hey, the properties are around $30,000, and they are like, why is it so cheap, right? And then they got a little bit like, because it's so cheap that they don't trust it, right? So that's number one objection. And then number two is, when I talked about what kind of tenants that we are bringing in, and also, they get a little bit skittish. Okay, what if, Yeah, people got, even though like I can explain all the things that we are doing to protect like insurance and everything, but people they get like scared essentially, right? So how do you typically handle this kind of objection?
Okay, so let's start with the idea of why are they 30,000. So you do remember, right? You're a certified private money lender. I went through that in the training. Is that there's an economics behind it. So depending on how much they can take, you can give them that economics lesson about the markets, which is this, which Scott also teaches. These homes are in these special markets where the valuation have not been. If you want to simplify it, you can simplify it by saying that these are markets where the value has been stagnant for an extended period of time. Okay, the actual replacement cost of these homes are no less than in nicer neighborhoods, right? The condition, yes, but I'm talking about the replacement cost, right? The replacement cost to even a stick built home is a lot more than what you're buying for. So if you're buying a thirty
Yeah,
thousand dollar home and it's a 3 bedroom home, the replacement cost is obviously more than that, right? But that's not what we're talking about. We are talking about the valuation stagnation. So the value has been stagnant for extended period of time, 20 years. So what happens after 20 years is that they fall below the threshold for traditional lenders. So the banks don't lend less than 70,000 and this home is worth 30,000. Well, guess what? Nobody can borrow in these areas, right? Now, I'm just explaining this to you, right? So it's
Hmm.
your job if they're asking so many questions and if they're really curious and you want to answer that question, if you answer it to that depth, then they understand that there is an economic reason for that, not that this is happening just casually and it might not happen tomorrow, right? So when you explain that this has been going on for the last 20 years because that price stagnation is not a 2 year or 5 year thing. It's been going on for 20 years, right? You can go out and actually look at the data. I'm not suggesting you share all this data with them, but the fact that you can have this conversation briefly, compress it so you you don't spend the whole session doing it, but compress it so they know that you understand what you're doing. That's what they're really trying to figure out. It's, do you know what you're doing? Right? It's not
yeah,
more of what the thing is. So if you can compress this discussion that I did in even more, and then just answer the question rather than have no answer. That's what the key is in this. Now the second part was, sorry, remind me, what was the second part?
about the tenants, right?
Yeah.
If you sell the house, I did not mention like no credit check, but also I would say like middle income, like low income families,
Here's what
yeah,
you do. Do not even go into details. Just say, oh, we manage the process. We take care of showing them the home. We do this. Don't go, even if they ask you, don't go into details about, say that, oh, don't worry about that. We have a full team. We do the, we manage the process. And the reason why I tell them I don't want to give you the details is because, that's not your job. You're a passive investor. That's my job. I do all the hard work. Do you see that? So you're not trying to hide, but just it's not necessary to go into those details. Now, obviously, if somebody is just adamant they really want to know this, honestly, all my private money lenders know exactly what they're investing in. I tell them, I use the word distressed property. I tell them about the condition. I show them the picture. So by the time they're looking at the picture and walk through videos, they know what to expect. They're not like, oh my God, it's not that way. And I'm not saying that's the best way, but that's what I do, and it works.
yeah. Well, one follow up, right? Usually,
Yeah.
like on the first question, what I get is, okay, how do you know the price will not go further down? Today it could be $30,000. 2 years from now, it could be $20,000.
Okay. So to them it shouldn't matter. Why does it matter? It matters in the sense that their asset valuation will go down, right? That's their logic, right?
Is
Because you're
that
not
yeah,
selling the property, there's no exit. Well, here's the best
yeah,
answer. This is what I do. I'm not sure if you do, and a lot of people don't do it. I never buy properties at a price that their value is at that price or lower. I always buy them with equity built in. So I buy properties with at least 30% equity built in, which means if they even lose value, they'll still be, you can still sell them at the same price that you bought them at. Do you understand what
yeah.
I'm saying? So,
Hmm.
but if you are buying properties At below, that's why that's what I teach in my newbie calls is don't buy properties if you know they're not even worth what they're being listed at, because that would be a red flag for your private money lender, because your private money lender will find out, oh, wait, this property is not even worth 20 grand and he's borrowing 30 grand. So although I do this, I do borrow 30 and I might buy it at 25, but I know the property is worth 35 or 37 or 38, right? So that's how I show my private money lenders with comms and rental comms and all that kind of stuff.
Gotcha. Awesome. Thank
All
you so
right,
much, Amir.
cool.
Appreciate
Sure.
it.
Jason, go ahead and unmute yourself.
Can you hear me?
Yes, I can.
Good, good. So, how do you handle the question of when you advertise 12% in returns? I've had some finance geeks tell me that it really doesn't come out to 12% the way we structured the loans, that it's more like 7 or 8%. How do
Awesome.
you go ahead?
Awesome question. I had a private money lender ask me that recently. So I have a great answer for you. Watch this. So tell them that, ask them, I just want to make sure, do you understand how an amortization table works? Well, guess what they're going to say? Oh, yeah, I know how it works. I know that I use it all the time, right? Well,
Yeah.
ask them this. Ask them, do you have a home? Is it financed? And well, 90% of the case, they'll say, yeah, it's financed. Say, okay, well, let's say Wells Fargo lent you, your home was $200,000. When they lent you the funds to buy that home, do you know the interest rate? And they say, yeah, mine is at 5%, 4%, whatever, right? So I said,
Yeah.
okay, well, think of it this way. What you're just saying right now, that Wells Fargo is not getting 5%. They're fools. Even though they're saying it's 5%, but they're actually making less. Remember, that's an amortized loan. Do you see what I'm
Yeah.
saying?
Yeah,
Okay,
exactly.
here's the answer. Here's what the answer is. And this Scott explains it really well. It's just that you can explain it many different ways. Wells Fargo knows that yes, they might earn less, but what they're doing is when the principal comes back, they invest it again, right? They invest both the interest and the principal to earn it way more than that they can on 5%. So the answer is this: the fact that they're getting their principal back, they're free to do whatever they want with that money, right? Plus the interest, they can reinvest it and they can earn multiple times more. Nobody in their right mind will just take the money and just sit on it. Nobody does that. All
Yeah.
people. So this logic does not make sense. So the best thing is just say that, it's the same logic. If Wells Fargo is lending you at 5%, do you think that they're actually earning less, but they still say it's 5%? That doesn't make sense. But the simple answer is that's how the amortization table works. And you are free to do whatever you want with the principal. You can reinvest it and earn way more than 12%. All right. But you're absolutely right. If somebody's giving you that argument and they don't understand how amortization table works, or they're just trying to convince you that you're paying less than 12%, well, you're still paying 12%, no matter what. That is the truth. You are paying 12% on the balance. So
Yeah.
you're not misrepresenting yourself. They're just trying to convince you by saying that, oh, because my principal is coming back, I'm not getting. It doesn't work that. That's not how amortization table works.
I like the simple answer. I like comparing it to a traditional mortgage, and yeah, that's
Go for
brilliant.
it. Just go for it. But I can tell you a lot
Yeah.
of these people, they're just made up their mind. Okay? So no matter what you're gonna say, they're just not gonna invest with you. Which is that's why you don't want to go into this kind of a discussion with them, because you're like, okay, well, this person either doesn't understand or they're just nitpicking on these things. And well, frankly, how are they going to invest? So let me also tell you, these are the people who invest in fix and flip. And I can tell you what happens. They get burned because when they invest in fix and flips, they're getting interest only payment. And when the investment fails, they lose all the the benefit that they were expecting they're going to get. So I'm not saying all of them, but all of these people who do this, they're comparing a fix and flip kind of a model, which is they're getting interest only payment and then lump sum payment at the end of the project. Obviously, our model is very different.
Definitely. Thank you, Amir.
Sure, absolutely. All right, guys, let me move on to the next one. I don't want to keep you guys here today. So here's the summary. Like I said, Get good at evaluating and recognizing which type of lender you're talking to. Very important. Based on my guidelines, stop wasting time talking to traditional lenders and hard money lenders. And then finally, get really good at recognizing the difference between sophisticated PML and emerging PML. And finally, spend more time with sophisticated and emerging